Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. We are going to talk to David Friedman today. He's the co-founder and CEO of Knox Financial, a financial services company specializing in helping people turn the homes they are moving out of into market-beating investment properties. So he has built a frictionless ownership platform, and through this platform, David allows investors from finding renters to property maintenance and even managing financings. So I am looking forward to this episode just to know how he does this all. Thank you, David.
Oh, it's great to be here. I appreciate it.
Absolutely. So David, the first question I ask every guest is, tell us something interesting or funny about yourself.
Something interesting. When I was 16 years old, I bicycled across the United States from the Pacific Ocean to the Atlantic Ocean.
No way.
Yep.
Whoa.
And I'm still an avid cyclist to this day. I bicycle to and from the office, which is about a 25-mile round trip, several days a week. And I just taught my oldest of 3 kids to ride a bike in the last few weeks, and that's exciting.
That's awesome. How long did it take you to go from Pacific to Atlantic?
It was 58 days. It was basically 8 weeks, and we took 1 day a week off. So we rode for 50 days in 8 weeks.
And how many miles a day?
What's funny is it comes out to 70 to 80 miles a day, but
wow.
we never rode that distance. You're in the mountains, you're riding 50 or 65. And then when you're in the flats, you're riding 90, 100 miles a day.
Correct.
So
yeah. It averages out basically. Because when you're going flat or downhill, of course, you can go much faster. Wow, that's crazy. So but during the pandemic, I also picked up biking. I bought a road bike. Now I have recently bought a triathlon bike, so yep. I know.
I've done a number of triathlons as well in my 20s.
Oh, that's great. So let's talk about real estate. How did you personally get started with real estate?
Sure. So when I was in college, I was renting a house near campus. I went to Tufts University, and it was around the time when I figured out that assets had value. I became aware of the financial markets. It was the dot-com boom, and the economy was all in the news. And I started looking up, what the value of the property I was renting in. I was a 2-family, and I realized that the owner of that property was just making a mint. So that turned me on to real estate, and I decided I needed to not pay someone else's mortgage, but buy a home. And then I realized that if I was going to buy a 1-bedroom unit, and I said, no, I should buy a 2-bedroom and charge my roommate rent.
Exactly.
And they would subsidize. So the first real estate quote investment I made was buying a 2-bedroom condo. And one of my 4 roommates, when we were renting, moved in with me. And the result was his rent paid my mortgage, and we split the bills.
Well, this is amazing. Then when was it?
That was 20 years ago, almost to the day. Oh my gosh. Thank you for reminding me of that. Just over 20 years ago.
And how did that investment work out for you overall?
Well, what's funny about that investment is that, it was a fantastic investment, but that investment is actually part of why we launched Knox. And it's almost like we planned this, but of course we didn't plan this conversation at all. So I lived in that home for 10 years.
Wow.
When I bought it, it was my 20s bachelor pad. When I moved out, because I moved in with my now wife, and we have 3 kids, and it was sort of the beginning of the next phase of my life. So, I moved in when I was in grad school, and I moved out when I was engaged. So that chunk of my life. So I lived in it for a little over 10 years, and I put $100,000 down when I bought it, and when I sold it, I turned that $100,000 into $350,000.
Nice. And you are paying mortgage for free, pretty much. You are.
Yeah, and here's the other thing. So what happened was 4 years later, the new owners that I had sold it to, they sold it again, and they made another $200,000 on that property. And I saw this and I felt like somebody had stolen $200,000 from me because
that's what happens with us, right?
Yeah,
Every time we
right.
see that asset, I'm like, oh no, I shouldn't have done
So,
it.
and that is the founding story of my company. So we started Knox because I thought somebody had stolen this money from me, and I went and told everybody that I knew, but an idiot I was. I made this huge investing mistake. I knew I never should have sold that home. I told them, and everybody said, the same thing happened to me. And so we started Knox because that is actually one of the biggest investment opportunities, actually the biggest investment opportunities that most people ever come into, which is when they move, holding onto their home.
Oh, that's very interesting. So how do you get rid of owning and managing the burden of owning and managing rental properties?
Sure. So in having talked to thousands of clients, the burden is not one thing. It's multiple things.
Yes.
So the first burden is the financial burden and or stress. It's the unknown expense or the tenant that moves out without warning and breaks their lease.
Yes.
Or the tree that falls down in the store.
Yeah, there is a large turnover cost because they have messed up
Sure.
the apartment.
Sure. So, and then having to pull that out of your pocket. So you need to have what I like to call some water under your keel. So you need to have some access to liquidity.
Correct.
That doesn't mean you have to have cash sitting in a bank account. You need some kind of credit. So a line of credit is very helpful.
Credit. Okay.
Yeah. So that's the first thing. It's just take the stress out of the financial burden. You don't want to be in a position down the road where it impacts your ability to make the mortgage payment on your primary home or
Right.
pay for the other things you want to enjoy life. The next thing is the surprises that come from tenants.
Right.
When they call and they need something at 11 o'clock on a Saturday night. So you probably want to have somebody else pick up the phone.
Right.
Yeah. And then the final is, and this is sort of in between the two, is the replacement of tenants and keeping them happy.
Right.
And when they do get replaced, or even if they don't get replaced, it's the leasing, it's the raising of rent. A lot of people would get stressed around that conversation.
Renewing the lease. Yeah.
Renewing the lease. And then if they move out, finding a new tenant and the costs associated with that, because you could have vacancy and then you could also be paying a realtor fee of, say a month's rent to replace that tenant, and then legal fees for leasing, et cetera. So those are usually the stress points that we we alleviate for customers.
So yes, I'm mostly aware of that side where someone finds the tenant for you, manages the property. That's the property manager, right? Which is what I do. But the line of credit is something, of course, I haven't done or I haven't heard of. So how do you work with the client? Do you when they are moving out, or do you also help them in buying a rental property?
So we're not in the business of helping you buy rental property at the moment. Someday we might do that, but there's a world of very qualified real estate agents will help you buy a property. Our clients, one of the first things we do with a lot of them is help them get access to the equity in the home that they own and they're moving out of. They use that equity for usually one of, say, three things. First of all, they need it for the down payment on the home they're going to buy.
Right.
Sometimes they need it to do some make ready and touch up work on their home. And then sometimes the property is going to be negative cash flowing in the beginning, but they're confident in the value appreciation and the rent growth they expect, so will be profitable in the future. So we offer a few different financing options. The one that is unique to Knox is called a keep loan. And I don't want to just talk about Knox today, but we've created what feels a lot like a home equity line of credit. The difference between ours and one you might get from a bank is we're fine if you plan on moving out next week, or even if you've already moved out. Whereas a bank is not going to give you a line of credit on a home you're about to move out of as if you were a homeowner. So we've created a special product to allow people to access that equity without selling.
Oh, that's awesome. And I saw your bio, and there was one thing which was mentioned that it was reliable cash flow. So how do you create a reliable cash flow for investors?
There's two ways. First of all, if you have this line of credit, we do not encourage our customers to pull 100% of their line of credit day one.
Correct.
having that liquidity is part of how we talked about, you de-stress. So you can have a line of credit, and then let's say a property is producing $500 a month in net cash flow, and then you need a new hot water heater, or it's time to replace the roof or something like that. You have a line of credit available to you, and your cash flow might get impacted by $20 or $40 a month, but you're still going to see most of it because you can put the expense on the line of credit and pay it off over time. The other thing that Knox is working on launching is a lease guarantee. So what will happen is we actually will guarantee a lease rate every month, no matter what, and Knox takes on the risk of vacancy or a tenant leaving early or just not paying rent.
So, okay, no, that's interesting, because I heard of this lease guarantee from some other property managers as well, and they work with certain insurance companies to do that. So do you also work with certain type of insurance company to provide this kind of lease guarantee?
So there are two types of products that you'll see in the marketplace. So Knox already offers something called Knox Rent Protection, where and that is basically, it's not insurance because it's a different type of product. It's not technically insurance. It's it's balance sheet risk that we take on, however, where for a fee we will backstop up to 3 months of missed rent for almost any reason short of like acts of God or something like that. Whereas a lease guarantee, Knox is actually renting the home from you, and we are the renter. So Knox's balance sheet, which is much, much, much larger than a tenant's, is paying you rent, and then we go and lease the property to a resident under a sublease. Sublease,
yes. Okay, no, that's very interesting. And how did you get all the ideas about? Of course, you mentioned from that condo when you sold, but how did you come up with all these ideas about creating the cash flow, line of credit, lease guarantee?
Yeah, so while I was living in that condo, I was running a different technology company that made us, to this day, still makes software for the real estate brokerage space. And I built that over more than a decade. We sold that company, and I learned an awful lot about the data behind the real estate industry and the mortgage industry and the insurance industry. And we came to understand that the data model, really two data models and where they intersect. One is property. So you have homes, and those homes have certain physical attributes like beds and baths and things like that. But then they also have metadata, like a value and the trend of that value and the rent you can expect and the trend of that rent. And that all splices with people data. And those people are owners and residents. And owners also have metadata, like their credit and their investment goals, and tenants have similar things. And so when you splice those together, you realize there's all sorts of opportunities to help the owners build wealth and create a long-term relationship with the tenant where you give them a safe and comfortable place to live, but you also help them achieve financial goals, just like you help the owners achieve financial goals through their property. And we created Knox to help people who are moving out of their homes leverage this investment and then work with those folks and the tenants for years to come.
No, that's great. And so we spoke about renting your house, and then you are going to help with the property management, lease guarantee, etc. Do you come up with different investment strategies depending on the client?
The first question we ask every client, the first part of every conversation is, what are your investing goals? So we have built proprietary investment analysis software that allows us to take your property or your portfolio and run numbers right in front of you. We do a Zoom with you, and we show you how the home can be sort of molded to meet your financial goals. Similar to meeting with an advisor at Morgan Stanley or Goldman Sachs or Merrill Lynch. Right. They're going to say, okay, here's your portfolio of stocks and bonds and mutual funds. Let's see what we have to do to make you or to help you achieve your financial goals. We do the exact same thing, but we use the property portfolio. Generally, we find clients are looking for one of three things or maybe a balance. Generally, if you're earlier in life and your household has one or two stable and growing W-2 incomes, people are looking for rate of return. They're living off their paychecks, and they're not necessarily looking for their investments to cash flow
appreciation. Yeah.
Right. They want what is my rate of return? And real estate can offer unbelievable rates of return because of the leverage you can put on a property. Even responsible leverage on a property will dramatically beat the S&P because it's very hard for a normal person to get a levered return on the public market. On the other end of life, you've got people who are downsizing or retiring, and they want reliable cash flow. And they also like, and here's a third strategy, they like tax advantaged returns.
Yes.
And property, the same house, depending on who you are, can provide either a high IRR and a low cash flow, or a modest IRR and a really nice cash flow. In all cases, the IRR of the, if you want a high IRR, we could probably engineer it to dramatically beat the public markets. And if you are looking for steady cash flow, you could almost certainly engineer things to outperform the bond market or the fixed income market. So the properties that people own really are an unbelievable investment opportunity.
So I'm glad that you brought up the point about appreciation and cash flow. Can you share an example on how you come up with this different investment strategy? Maybe share a number, one house, and how you come up with those strategies.
Yeah, I'll just, let's talk about the same exact, let's take a $300,000 house. That's very, very simple strategy. Let's just say you own $100,000 of the equity and you have $200,000 in mortgage debt on a $300,000 house. If that house goes up in value $100,000 or 33%, you've doubled your equity value. So, according to the Wall Street Journal, in the month of March, the average home in America went up in value over 20%.
Yeah.
So that $300,000, sorry, not in that month, sorry, the annualized, annualized, thank you, 20%. So if you owned a $300,000 house the prior March and it was the average home in America, a year later, it was worth $360,000. If you had $100,000 in equity, you have $160,000 in equity. That's a 60% rate of return on that property. And that's assuming that, and I'm gonna make another big assumption on that investment. There was no net cash flow in that year. Your expenses and your revenue were even. You still made a 60% rate of return. That's before your mortgage principal being paid down every month, bit by bit. Now let's take somebody else that owns that house. It's somebody who's lived in it for 30 years. They're retiring and moving out and they have no debt. Okay. So their equity is not $100,000, it's $300,000. It still goes up in value, that's $60,000. Instead of having that enormous rate of return, they had a 20% rate of return, right? Which is 60 is amazing. 20 is still amazing. And this is a very rare time for real estate. This is not going to sustain forever. But at the same time, that property with no debt is likely to have a really nice cash flow on top because you're paying taxes and insurance, but you're probably going to see more income than just the taxes and insurance on that home. So whatever the net cash flow was on top of that would be your passive income on that home. And this is the one of the main trade-offs is how much leverage you put on the property. Going 3-to-1 equity to debt is actually pretty conservative in real estate. Having $100,000 down on a $300,000 property, and you still get these unbelievable rates of return in a time when there's a lot of uncertainty in the market, in the public market. So that's the type of difference in strategy we'd be talking about.
Oh, that's great. Now let's take a different direction. What are some of the challenges you have faced from the financial side, right? Of course, because you have the KEEP loan and maybe other financial products you're offering. And also with the interest rates rising, what are you seeing on that side?
Sure. I'll answer the last part first. So if you go back even just 6 months, a fantastic way to grab equity from the home you're moving out of was a refinancing.
Yes.
Now, even still, a bank's not really going to give you refinancing if you're planning on moving out soon. So you still need some kind of specialized product, and that's part of why we built the KEEP loan. But in doing a refi or a cash out refi, you could get that equity and put it in your bank account for the down payment on your next home or for make ready work or what have you. today, if you're like lots and lots of Americans, you have this wonderfully low interest rate on your primary mortgage on your home. And that mortgage is probably as low or lower than any you will ever get. So the paper that mortgage is printed on is one of the best investments you own. So if you want access to your equity, refinancing it to a point or 2 or 3 points higher than what you're paying would be a huge financial mistake.
Correct.
So what you want is a second mortgage lien. So you want a home equity line of credit or a home equity loan. The nice thing about a home equity line of credit is you don't have to draw it all right away.
It's like a credit card. I love it.
Yeah, there's almost always some initial draw requirement, like 25% or something like that. Yeah. But if you do a home equity loan, it's basically a second mortgage. You draw it all up front, you pay it off over a long period of time, kind of like your primary mortgage. So the nice thing about the line of credit is it adds all sorts of flexibility, and your monthly carrying costs don't go up that much if you draw a small amount up front and keep the rest for future use.
Correct.
So to go a little technical, what people are able to do is create a blended cost of capital. So they've got most of their mortgage financing in this larger note, this larger mortgage that is very cheap. And then they have a small amount of liquidity available in a slightly more expensive note at today's rates that they don't even have to draw on. The result is a really nice mix of mortgage products. Now, you said what is the most challenging thing we've found? In order to secure financial backing for our lending product, we went and talked to over 25 funds, like multi-billion-dollar funds, and we pitched many of them and to see who was willing to give us money to lend.
Right.
And that was a many months long process of talking to funds and lawyers and fund stuff. So that was a long process, but in the very near future, we're going to be announcing that we have secured a very large backer for making many millions more dollars worth of those loans.
So that's awesome. I'm going to throw you a curveball, and just because I'm in San Francisco Bay Area, and of course you are in Massachusetts, but here and everywhere the property prices have gone up. Let's say I own and everything here is, even a condo is $1 million right now, right? So let's say I own $1 million house, and I end up refinancing it or adding the second loan. Now, if I go and try to buy another house for myself, everything is over 1.5 to 2 million. Would I be able to even qualify now? I have even added additional mortgage on top.
Right. This is a part of what we help folks do. So I don't know how in the weeds you want to get on this math.
No, just
but by making sure you have a lease on the home you're moving out of,
yes,
we help you qualify. So that lease, when you lease up the home you're moving out of and go qualify for your next mortgage, the bank wants to see that lease. They want to see that it has, right. They want it to have a start date no more than 60 days after closing on the new mortgage. That's a Fannie and Freddie guideline. And then they're going to give you about 75 cents on the dollar credit as if it were income. So if you had a $4,000 monthly rent check or lease for $4,000 a month, they're going to give you as if you were making another $3,000 in income. Right. And that's part of the alchemy that we make sure is the math is done right so that you do qualify and you can buy the home. And then of course we get you the equity out of that property so you can make the down payment on that new property.
No, that's great. And I knew the answer. I just wanted my listeners to know.
Oh,
right?
You're a lawyer. You know the answers to the questions you asked first.
No, and because I want them to understand that you got to have lease in the hand. You have to be able to lease. And the second point which you made was great, that they will give you 75 cents on the dollar because it's not a seasoned lease. When I'm investing already for a couple of years, I'm able to pretty much get dollar for my lease. But when it's not a seasoned lease, that's what you get from the bank. So no, thank you for explaining that. So we spoke about the financial side. Now I want to talk about a little bit about property management side. Can you share some horror stories? you have seen from property
Oh man,
management arm?
sure. I mean, they happen. I'll tell you that the horror stories usually happen, and this is an unfortunate thing, and I don't want to, point fingers too much, but we find that the most difficult situations are when there's a repair needed, and we call the owner and say, "Hi, this is a necessary repair. The tenant has reported this issue." We call them residents. I'm sorry, the resident has reported this issue, and the owner says, "I don't want to make that repair."
Right.
And now we are caught in the middle, and we tell them, "This is not something you can just leave there. This is actually important." Or even worse, they say, "Oh, the quote you gave me is too high."
Yes.
But they don't realize is that there are supply chain issues, labor shortage issues. So, we had a client who had a leaky skylight. And I don't remember what the quote was. I don't even know what the quote was, but they thought it was way too high. And so the tenant was very unhappy. The resident was very unhappy because it took so long to fix. That was because the owner didn't like our price quote. Of course, we use only licensed contractors and subs. So we end up with an unhappy owner and an unhappy tenant because the owner now says, "Oh, geez, I have to go find my own guy."
Right.
And we say, "Well, you might find somebody who's cheaper, but odds they're going to be licensed and bonded and all these things." So that is the biggest challenge we find. I would say another challenge in property management, or we call it property maintenance generally. In property maintenance is when a tenant calls up and says, "I have this problem," and then we send somebody out, and the tenant is not cooperating, right?
Yes.
And whatever we've literally had to offer them incentives to show up and participate in the solution.
Right.
And that is sometimes a challenge. If it's a tenant we have placed, that's rarely the case. But sometimes we're inheriting a tenant that has been there a while and thinks they what's the word? They own the place, if you will, figuratively. Right.
Right.
So that's another challenge we've definitely faced.
Oh, this is awesome. Thank you so much for sharing all these stories as well as all the challenges. Let's take a quick break, and after the break, we'll go through the same questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. David shared a lot of golden nuggets today. I thoroughly enjoyed because I could definitely relate to the issues about the financing as well as the property management. I forgot to share a story. I flew to Atlanta to look at one of my duplex in April. We go there that morning and I thought, okay, my property manager also, I asked him to come and we can't get in the house because none of us had the key, and we thought the tenant was going to be around. And we also had scheduled an appointment. A tenant had agreed to that appointment that we needed to fix something. So those guys also showed up while I'm there, but none of us can get in the house. So,
there was this one property that in Texas that there are four units, and there was only one heating system.
Oh,
and the owner had an agreement again with inherited tenants. It's more challenging that he would divide it by, send them the bill and divide it up. And we wanted to just make it a fixed price in the lease anyway. We inherited these tenants,
right.
And we went to have a sit down with the tenants and be like very personable with these folks. And the big complainer tenant didn't show up to the meeting.
Right.
Everybody else was there and thanked us and appreciated it. And we handed them Starbucks gift cards for their time. The biggest complainer didn't even make it.
That's exactly what happens. Yeah. Remember those HOM meetings, the people who complain the most, they never show up. They send email, "Oh, we got to talk about this," and they never show up.
The minute you say, "Hey, I'm going to come and meet with you in person, and we're gonna hash this out like human beings," they don't even show up.
Yeah, exactly. No, this is great. So David, are you ready for fire round?
Yes.
Would you be changing any business or investment strategy after this pandemic is over?
I personally, and it's not that the pandemic is over, but now that the pandemic is over, there are market shifts happening.
Yes.
During the pandemic, there were opportunities that are different than the opportunities that are now. So the pandemic itself, I do not believe has changed any of my strategies. I think that the pandemic and all of the interest rate drops, that the unbelievably low interest rates that existed for 2 years there, are going to cause many property owners to change their own strategies because they have so much home equity.
Yes.
We believe that very strongly. And that, I think, is a ripple effect that's going to be part of our economy for the next 10 or 20 years.
Oh, that's great. Favorite real estate or finance related book?
My favorite finance related book, it's not really a finance related book. It's a startup related book, but Peter Thiel's book, 0 to 1.
Yes,
it's a business book. Is an unbelievably good book.
No, I agree. Any tool or website you recommend or you cannot live without?
It's funny. I've tried to of late remove myself from a lot of websites, but the tool that I use the most is Excel.
Yes.
I actually think that somebody needs to, and I'll tell you something. Excel is the popular version of the spreadsheet that everybody uses, but the first spreadsheet was called VisiCalc. And
yes.
Yeah, one of the inventors was an investor in my last company, and Bob Frankston, and I've known Bob Frankston for 15 years. At MIT, he and a few other people invented the first spreadsheet software, which is, I think if you really chart the way markets work and the valuation trends in many asset classes, including real estate, the adoption of spreadsheets has driven yields and margins down and down and down. And I think that I personally believe that is one of the biggest drivers in economic change the last 40 years.
Wow, that's such a great insight. I never thought of it.
I can think about it. You used to have entire rooms full of people doing the math
Correct.
on deals and accounting and spreadsheets. You had mainframe computers. My dad had a career in mainframes. And then in the 80s and 90s, it went to everybody on their desktop, and everybody could run the numbers. Everybody could build a financial model. Yeah. And the ripple effect of that is now you can download an app and build your own quant strategy on the market.
Yeah. Any advice for beginner investors?
Nothing sage. I could give you the beginner investors in general. Start small, diversify. Beginning property investors, I always tell people, most property investments require more upfront investment than you plan for. So it's not just the purchase price and the closing costs. When you turn a property into an investment, whether you're moving out or you're buying it, there will be other upfront costs in the first 24 months, and you should plan for them, and you should have some liquidity for them.
That's a great advice. How do you give back?
Earlier today in this very office, I had a group of CEOs that I meet with monthly, and the conversations I have with those folks helping one another is a big part of how I give back. I also am involved with my synagogue, and have been for a long time. Actually, since I've had small children, I'm less involved, but as they grow up and become aware of religion, we will become more involved again. But being involved with my synagogue has always been an important part of my life.
Oh, that's great. How can my listeners reach out to you?
You can always reach out through knoxfinancial.com, and you can reach out to me or my entire team.
Thank you so much, David, for your time. I definitely had fun.
Yeah, I enjoyed this conversation very much. Thank you.
Thank you.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!